This is a story of how I developed a strategy to win a 1-month trading challenge while having absolutely no experience with trading oil or gas futures and any fundamental knowledge to begin with. But before we get into the results and finally the strategy I developed, let me just say that if you ever get the chance to participate in a paper trading challenge, take it. Even though you're trading with paper money, the emotions are from my experience very similar to trading with real money. That is, if you actually want to win the challenge. Every time my position turned red and my name dropped on the leaderboard for all the traders to see, I felt anxiety. I was nervous and most importantly, I felt like I had something to lose and potentially gain. Don't get me wrong, trying out trading strategies with paper money while trading on your own is fine, but you don't get the same feeling, the fear, the raw emotion of having something to lose like when you trade with real money. And you get all of that by trading in a paper trading challenge. The only caveat is that you actually have to try and you have to want to win. You have to be competitive enough that to you it's not about the money, it's about the number one spot on the leaderboard. Only then will you feel the same emotions with paper trading as you do with real money, which is why I think joining a paper trading challenge is absolutely the best way to start day trading. If you watched my channel, you know that I actively invest in stocks. You could even say I swing trade, but I have never traded oil or natural gas futures before. I have day traded a bit of Nasdaq futures in the past, but all of that was with paper money, so there weren't any stakes involved. On top of that, I'm in a process of getting a master's in an engineering major, so I don't have any fundamental knowledge for trading commodities. And yet, I was still able to develop a day trading strategy with which I made a 30% gain, had only 2 red days over a span of 4 weeks, and won this trading challenge. It all began when a friend sent me an invite to this trading challenge. At first I was skeptical about joining it since I haven't traded that much in the past, and I assumed most of the people participating would be traders with extensive experience. But with literally nothing to lose, I decided to send my application. After a couple of weeks I received an email saying that among about 600 applicants, I, along with other 149 people, was accepted to this challenge. A couple of hours before the challenge began, we were told that we were going to trade Henry Hub natural gas and crude oil futures. And so it all started on Monday, November the 4th. But I didn't trade that day because I honestly didn't have time, so for me it all started on Tuesday, November the 5th, the election day. To any seasoned trader, dropping a beginner into trading on such a volatile day would be pure insanity. But I was eager to trade and thought I was going to successfully navigate the market. And I couldn't be more wrong. We were trading with $100,000 paper accounts, and on the very first day I realized a loss of $3,500, putting me dead last on the leaderboard. Not only that, but I also held a position overnight. That position luckily turned green the next day, but from then on I decided to never again hold positions overnight, with an exception one Thursday when I made a major loss, but more about that later. After that first red day I started making gains, and I mean a serious number of gains. I was on a 6-day winning streak, going from $96,500 to $115,750 while consistently making gains day after day. At that point I was firmly holding the number 2 spot on the leaderboard, but I wanted to get to that sweet number 1 spot. So the next day, on Thursday, November the 14th, I was absolutely sure I was going to take the lead. And well, that day was my worst day in the trading challenge, but in the end it was actually for the best because it showed me weaknesses in my trading strategy. I realized a loss of about $9,000 on natural gas while making a gain of about $3,000 on crude oil. On that day I was over trading with my emotions, and almost completely forgo my rules. I even held a position overnight, which I then closed the next day in the green. Still, on the only 2 red days I had, I held a position overnight, which is why I made it a firm rule to never do that again, and I'm glad to say that I stuck by it. The next day I recouped what I lost on Thursday plus more, making a $10,000 gain. Every day since then it was a green day, slowly getting my account to $129,640. Over the course of this challenge I've had 2 red days and 15 green days, achieving a 58% win rate on a trade to trade basis. Now on to the strategy itself. itself. As I said earlier, I was trading natural gas and crude oil futures, and I could hold a maximum of 10 contracts of natural gas and a maximum of 10 contracts of crude oil at any given time. While I was trading, I always looked at 3 charts at the same time: the 1-minute chart with a VWAP, the 5-minute chart with a VWAP, and the daily chart. The daily chart was more for getting the general direction of the market, while I was actively trading on the 1-minute chart. The 5-minute chart was there just so I could look at the movement of the price during the day without having to zoom out on the 1-minute chart. On top of that, I would like to explain a term I'll be using from here on. A tick refers to the smallest price movement of the asset I'm trading. So in crude oil, a tick is a single cent, and in natural gas, a tick is 1/10 of a cent. I use the same strategy for both oil and gas, and to put it simply, I was trading daily reversals. I would wait for the price to drop to daily lows and open a long contract, or I would wait for the price to rise to daily highs and open a short. But I didn't just go all in with 10 contracts, because sometimes the price can just continue dropping below daily lows or rising above daily highs. So here is what I did. Let's say the price is dropping, so I'm looking to open a long. After the price drops to daily lows, I would wait for it to start consolidating, which just means that it stays around the same level for some time. Generally, I would wait for 5 to 6 candles on the 1-minute chart before entering. Initially, I would set a limit buy order for one contract around the daily low and wait. Once it gets filled, I would set my stop loss just 5 to 10 ticks below the daily low and a take profit a couple of ticks below the VWAP. If the price starts rising, I would then gradually bring my stop loss up, following about 15 ticks behind the price, acting as a trailing stop loss. If instead the price drops down and it triggers my stop loss, I would once again wait for it to stop falling and start consolidating. Then I would enter with 2 contracts. If the price once again drops below my stop loss, I wait for it to start consolidating and then enter with 4 contracts. At this point, things change a bit. If the price once again drops to daily lows, but it doesn't yet break my stop loss on the 4 contracts, I would go long with another 4 contracts. But with these 4 contracts, I would set a stop loss just 5 ticks below the daily low and a take profit somewhere in the middle between the daily low and the VWAP. If the price starts going up, I would also follow the price more aggressively with the stop loss, about 7 ticks behind the price. That way, I would hold 4 contracts with a more loose trailing stop loss, and at the same time, I would hold 4 contracts with a more aggressive trailing stop loss. By doing that, I can make gains even if the price starts dropping back down by triggering my trailing stop loss. If the price drops back down to daily lows, I would once again enter with 4 contracts with a more aggressive trailing stop loss. I would repeat this process until my take profit or stop loss on the initial 4 contracts gets triggered. But let's say the price continues dropping after consolidating, triggering both of my stop losses on the 8 contracts combined. Well, in that case, I would once again wait for the price to start consolidating, after which I would enter with 10 contracts, setting a stop loss about 5 to 10 ticks below the daily low and a take profit a couple of ticks below the VWAP. If the price starts rising, I would once again follow it with my stop loss, but if it continues dropping and it triggers my stop loss, I would stop trading for the day and come back another day. I use this same strategy but inverted while the price is rising and I'm looking to enter short, so instead of entering at daily lows, I would enter at daily highs. I should also mention that this strategy changes a bit when there is a huge increase or decrease in price in a very short time on huge volume. So let's say I'm trading and the price is steadily rising. I've already made some trades and am currently in the red due to the price hitting my stop losses. If the price then jumps by 20 to 30 ticks in one candle, I would wait for it to start showing any signs of losing momentum and quickly enter with 4 short contracts. And here's where I learned to only enter with a limit order and not a market order, because with a limit order you can specify at which price price you want to open the position. Meanwhile, the market order will fill the position as quickly as possible no matter the price. That way I can minimize losses if the price continues rising, because I would also set a very tight stop loss just 4 ticks above the daily high. If on the next candle the price also jumps by a lot of ticks, I would once again enter a short, but with 8 contracts. If it jumps again, I would enter with 10 contracts, and if it jumps again, I would stop for the day. But if it starts dropping, I would continuously lower my stop loss, following about 10 to 15 ticks behind the price while setting the take profit slightly above the VWAP. While I was trading, I've also learned a couple of things. Patience is the most important thing when it comes to trading. On the first red day, the price was constantly falling and I was just continuously opening long positions as I wasn't waiting for the consolidation. It was like trying to catch a falling knife. I did the same thing on the second red day. From that, I learned that you have to be patient and just wait for a great opportunity to enter. At the end of the day, I spent way more time just waiting, looking at the chart without any open positions, than actively trading or holding contracts. And the second thing is to never hold positions overnight. In fact, I only held positions while I was at the screen, with my average hold time probably being less than 40 minutes. Having that said, I'm not a financial advisor nor a professional day trader, so if you do end up trying this strategy, I implore you to try it with a paper account, ideally in a trading challenge, before trying it with real money. If you have any questions, leave them in the comments down below. If you'd like to see more of my content, click on the video just popped up, and if you like my channel, make sure to subscribe, and thanks for watching.